So everyone is cheering $600 billion AI boom, but no one is asking how it's being funded. And let me say this clearly before we start. What I'm about to share is my personal conclusion after going through earning calls, capital expenditure guidance, bond issuance data, and macro liquidity trends. And once you connect the dots, something becomes very uncomfortable. Because the biggest risk to tech stocks right now is not regulation, it's not even competition, and not even a recession. It's the $600 billion AI spending wave that everyone is celebrating. And let's start with the headline number. By 2026, the largest technology companies, the hyperscalers, are projected to spend over $600 billion on AI-related capital expenditures. And we are talking about data centers, GPUs, networking infrastructure, and specialized chips. And this spending is coming primarily from companies like Google, Microsoft, Amazon, Meta, and Apple, indirectly through ecosystems and services AI. On the surface, this sounds bullish. Massive investment, future growth, and the next industrial revolution. And that's the narrative. But markets don't crash because people invest too little. They crash because capital gets mispriced and misallocated. And historically, this level of concentrated spending has never ended well when it's funded under tight liquidity conditions. And how this spending is actually being funded. And here's where the story changes. So this AI build out is not being funded purely by free cash flow. A significant portion is being funded by debt issuance, bond sales, refinancing at higher interest rates, and in some cases reduced buybacks or stressed balance sheets. And recent bond market data shows that the tech sector now accounts for roughly 12% of total corporate bond issuance, and that's 5 times higher than during the dot-com era, happening when interest rates are structurally higher and when refinancing costs are no longer cheap. In other words, tech companies are borrowing more at worse terms to fund projects with uncertain payoffs, and that is not a stable setup. The rent always comes due, and here's the part that doesn't show up in hype videos. AI infrastructure is not a one-time expense. It's not like software, it's physical, it depreciates, and it requires constant upgrades. And most importantly, it must generate returns fast enough to service debt. Whether AI monetization succeeds or fails, the following costs are fixed: interest payments, bond maturities, operating expenses, and power and maintenance cost. So there is no wait and see option when debt is involved. If yields stay high and all current data suggest they will, refinancing becomes harder, not easier, and suddenly what looked like visionary investment starts to look like a cash flow problem. And why high rates changes everything. So this is where macro meets tech. Markets are still behaving as if rates will fall back to zero, capital will get cheap again, but inflation data tells a different story. Inflation has been sticky around the 2.4 to 2.6% range for months, and tariffs are adding pressure. Energy and service costs are not collapsing, and trade tensions are keeping supply chains inefficient. That means long-term rates stay elevated. Even if the Fed cuts short-term rates, long-duration capital, the kind used to fund data centers, remains expensive. So now ask yourself question, how do you justify trillion-dollar tech valuation when the cost of capital has permanently reset higher? And that's the question markets are starting to grapple with. AI demand is real, but it's not guaranteed revenue. And let's talk about demand. Yes, AI usage is exploding. Yes, adoption is real, but usage does not equal profitability. Right now, many AI services are heavily subsidized. Pricing power is unclear. Enterprises are experimenting, not committing long term. Margins are being sacrificed for growth optics, and we have seen this movie before. Cloud computing also took years to become meaningfully profitable, and that happened in a zero rate world. AI is scaling in a high rate world, and that difference matters. If enterprises spending slows even slightly due to recession, budget tightening, or consumer weakness, the revenue ramp falls short while cost remains locked in. And market don't forgive that. And here's a systematic risk few people are talking about. When tech companies issue massive amount of debt, they crowd out other borrowers. That includes small businesses, housing infrastructure, and even government debt. And capital is finite. If $600 billion flows into AI data centers, that money is not available elsewhere. This raises yield across the boards and tighten finance condition, not just for tech but for the entire economy. Ironically, AI spending may be accelerating the very liquidity squeeze that threatens tech valuation. The treasury problem nobody wants to touch. Now zoom out further. The US government is running massive deficits, and bond issuance is rising, and debt needs to be rolled over at higher yields. At the same time, tech wants more capital, government wants more capital, and consumers are tapped out, and foreign buyers are less reliable. So that's a competition for funding, and tech is not guaranteed to win. And if treasury yields rise further, tech bonds must offer even higher returns to attract buyers. That means higher interest cost, lower equity valuations, and less room for error. And this is how macro pressure quietly breaks growth stories. So why markets are starting to react? So now look at what matters are actually doing. We are seeing sudden tech sell-offs, volatility spikes, and liquidity driven asset sales, even gold being sold during stress. And that's classic liquidity crisis behavior. When money gets tight, investors sell what they can, not what they want. And high beta, high valuation tech stocks are always first in line. So this isn't a panic yet, but it's a recognition. And recognition that expectations may be too high, timelines too optimistic, and balance sheets more fragile than assumed. And this is not 2000, this is not the dot-com bubble. AI is real, revenue exists, companies are profitable. But the similarity lies in this is massive capital chasing a future that hasn't been monetized yet, under conditions that punish patience. So in 2000 the problem was no revenue. Today the problem is expensive capital. Different trigger, same output risk. So here's my honest opinion after reviewing the data. AI will absolutely change the world. Some companies will win big, productivity will improve, but markets have priced in success without pricing in risk. They have priced AI like it's happening in a zero rate, infinite liquidity environment. That world no longer exists. And if rates stay higher, liquidity stays tight, monetization takes longer, or growth disappoints even slightly, then the $600 billion AI spending wave stops looking like a catalyst and starts looking like a time bomb. And that's my view based on the data, not on hype, not on fear. But I want to hear from you. Do you think AI spending will justify these valuations? Or are market underestimating the cost of capital problem? So drop your thoughts in the comments, and we are entering a very different market regime.